Ladies and gentlemen, Asian Guy here. Today we redissecting a shocking call. Silver at $150 Oz in 2026. Said bluntly by a bullion dealer in an interview clip. But instead of believing or dismissing it, we put it on the table and cut into the mechanics. What does $150 actually require in physical supply demand, deliverable inventory, and the structure of the paper market? Context matters. 2025 was a parabolic year for silver, an outsized move that made it one of the standout commodities of the year. At the same time, a harder-to-reverse force sits underneath: industrial demand. The data people keep citing points to a very large industrial base, with solar as a major component. The implication is simple. Even when price rises and discretionary demand cools, industries that need silver to keep lines running usually adjust more slowly. Now move from why demand exists to how price explodes. Inventories and deliverability, metal that can be delivered to the right place in the right form at the right time. In London, the backbone of the OTC market, the headline vault number sounds huge. But London isn't a free-for-all warehouse. Its custody and settlement infrastructure and metal flows are constrained by contracts, fees, and the practical ability to mobilize bars. In the US COMEX, the most sensitive distinction is registered, available for delivery, versus eligible, meets specs but not committed for delivery. One recent snapshot is often quoted like this: total registered around 127.296 million ounces. Total eligible around 322.51 million ounces. Combined around 449.77 million ounces. This is where the 150 crowd aims their argument. If real delivery demand concentrates on registered inventory, the paper market can get forced into finding actual metal. But the immediate counterpoint is valid. Eligible isn't imaginary. It can be converted to registered if the owners agree. The hard question is, what price or what risk makes them agree? Then there's China. The SHFE futures market actually settles with physical delivery, and when retail surges, it tends to hit what can be touched domestically. One number is repeatedly used to illustrate the intensity. On 12/31/2025, SHFE silver trading value around 1.051 trillion CNY in a single day, converted loosely at about 7 CNY per USD. That was, I guess, roughly 150 billion out of turnover per day, an amount that can choke short-term liquidity if it all concentrates into the same narrow pipe. And what about SHFE inventory? Another commonly cited data point puts SHFE silver inventories at about 669.547 tons on 1/5/2026, down versus 12/31/2025. When visible inventories shrink, every $150 narrative collapses into one sentence. Whoever holds deliverable metal holds pricing power. But there's another layer: institutions and policy. The US has moved silver into a critical minerals framing in 2025. The meaning is not that silver is suddenly rare, but that it's increasingly treated as a supply chain security input tied to electronics, energy, and defense. Now back to the dealer Arias call. Why would someone say $150 with a straight face? Typically, the case rests on three pillars. 1, sustained deficits. 2, physical premiums, decoupling from paper pricing. And 3, a policy-geopolitical shock. Pillar 1 is the deficit story, multi-year balance pressure. Pillar 2 is premium. When physical gets scarce at delivery points, retail and regional spot can detach from futures, especially during stress. Pillar 3 is policy shock. A single change in trade rules, export controls, or delivery standards can raise the cost of getting silver to the right place, fast, causing step function repricing. But an investigation has to be fair. To reach $150, silver needs an accelerator mechanism, not just a trend. The most common accelerator is some combination of backwardation, delivery stress, and short covering, where paper sellers are forced to buy back because delivery risk becomes real. Now consider the technical pressure layer. Rule-based selling, like an index rebalance, can create sharp short-term drops even inside a bullish long-term story. And those shakeouts often become the fuel for the next squeeze because weak leverage gets flushed. Then there's the margin break. When margin rises, leverage disappears and undercapitalized players are forced out, regardless of whether their long-term thesis is correct. So when a dealer says $150, what they're really betting is that after repeated leverage crackdowns, the market snaps back to the hardest constraint: deliverable metal. Let's define what 150 means in plain math. If silver is around $70, $80, then $150 is nearly a doubling. Doubling within a year usually requires one of two things: an extreme macro regime shift or a structural market break. Monetary easing expectations can support precious metals broadly, but historically, gold tends to move first. Silver ignites. when you add a second engine, industrial pull plus thin inventories plus speculative positioning. That's also why silver is often described as having higher beta than gold. In prior cycles, silver has moved more violently on a percentage basis once momentum catches. The dealer S framing is usually, silver is an industrial metal priced like a precious metal. If both identities activate at once, price can gap. But the investigation must ask, if silver runs to $150, where does demand destruction come from? Typically, jewelry, non-essential industrial uses, and a portion of retail investment demand. In contrast, harder to substitute uses, electronics, conductivity-related applications, and parts of solar tend to adjust more slowly. Now we box 2026 into 3 scenarios to locate where $150 fits. Scenario A, normalization. Price corrects hard under mechanical selling and margin pressure, then chops sideways. In this world, $150 is fantasy. Scenario B, a controlled bull market. Silver rises on industry demand and rate expectations, but delivery structure does not break. Price climbs, but it has stairs, not an elevator. Scenario C, a structural break. Physical premiums persist, the market is forced to reprice deliverability, and paper gets dragged upward by delivery stress. This is the only scenario where $150 has a real lane. So what does structural break look like in data? Rapid drawdowns of deliverable inventory, declining registered stocks, and unusual delivery demand. Another sign is liquidity concentrating into the narrowest choke point, like trillion CNY turnover days coinciding with falling visible inventories. A third sign is a policy or geopolitical shift that makes silver sensitive, raising mobilization and transport frictions, or preventing the usual arbitrage flows from smoothing gaps. Now, here's the key. The dealer could be right for the wrong reason. They might guess the number correctly, but the real mechanism could be market plumbing jammed, not silver is gone from the earth. In fact, supply still exists and mine production continues. The deeper issue is that supply growth is slow because a large share of silver is produced as a byproduct of other mining. When supply is byproduct driven, higher silver prices donatillos automatically create a surge of new silver the way higher oil prices can quickly stimulate drilling. The lag is real. So when industrial demand rises, the market balances through one thing: price. Price forces someone to sell or forces weaker demand to exit. To reach $150, that balancing becomes extreme. Either physical holders refuse to sell below $150 or buyers become compelled to pay near $150 despite the price. In markets, that state tends to appear when confidence in the current pricing mechanism cracks, when paper prices are no longer seen as representing deliverable reality. Yes, a supportive macro backdrop can help, but $150 isn't a just support. $150 is a statement that challenges the structure, that asks. It's why a serious investigation has to ask 4 questions of the dealer, and you should ask them too when you hear $150. Question 1, is 150 a macro valuation call, rates, dollar inflation, or is it a deliverable squeeze call? Question 2, what's their deficit evidence base? Formal industry surveys and hard supply-demand work, or just retail desk impressions? Question 3, which inventories are they watching? LBMA London, COMEX registered, eligible, or SHFE warehouses? Question 4, what policy assumptions are they making, especially now that silver has been placed into a critical minerals framing, which can raise supply chain risk? Now let's run a clean cause and effect simulation of the path to $150, so we avoid vague storytelling. Step 1, industrial demand stays elevated, with solar still pulling hard. Solar at 243.7 MAs in 2024. Step 2, visible inventories tighten at 1 or more choke points. COMEX registered SHFE warehouses or liquid vault metal in London. Step 3, a persistent regional price gap appears, and arbitrage can T-close it because metal is hard to move or the cost of capital becomes too high. Step 4, market participants start paying up to guarantee access. Physical premiums expand and expectations reprice upward. Step 5, a technical shock, margin, rebalance, or short covering spikes volatility and forces futures to jump levels. Step 6, media amplification plus crowd psychology spreads the strategic silver narrative. Retail money concentrates into the narrowest pipe. Think trillion CNY turnover days on SHFE. If that whole chain runs cleanly, $150 can happen. But note the important caveat. This is a stress scenario, not a base case. And because it's a stress scenario, the downside risk is also stress level. When pressure eases, price can drop fast because silver is notoriously volatile. That's why the volatility risk around mechanical events like rebalances matters. It's the downside of an overcrowded market. In an investigation, we need a practical test for $150. If there is no delivery stress, then $150 becomes mostly macro plus mania. Macro plus mania can still print a top, but tops like that are rarely stable, and they often end with an elevator drop. On the other hand, if there is real delivery stress, price can stay anchored higher because the cost of mobilizing physical silver becomes a system cost. Now put the 150 call next to the hardest inputs we have. 1. Industrial demand at 689.1 and next to the most transparent storage points. 1. LBMA London at 27,187 tons. 2. COMEX registered at 127.26. Moz. 3. SHFE warehouse at 669.547 tons. A credible $150 forecast must explain why these storage pools can release metal quickly enough to cool the market. Retail dealers view markets through availability. They see product scarcity, rising premiums, and customers fighting supply. Those are real signals, but they can be local signals. Research has to separate scarcity from deliverable scarcity. COMEX registered versus eligible is the textbook example. So $150 is the anchor point for today. IS video, not because we declare it right or wrong, but because we lock down the necessary conditions for it to be right. Necessary condition. 1. Industrial demand does not fall sharply, and solar maintains momentum. Necessary condition. 2. Deliverable inventories get squeezed at a choke point for months, keeping physical premiums elevated. Necessary condition. 3. The paper market cannot crush the premium through arbitrage because of funding costs, logistics friction, or policy supply chain risk. Necessary condition. Thus, 4. Volatility gets mechanically triggered by rebalance, margin, or short covering, pushing price through psychological levels. If any one of these is missing, $150 can still print, but the probability drops sharply, and the time spent at $150 is usually short. Now back to the hook. Bullion dealer reveals. These videos work because they hand you a number, but investigative journalism doesn't buy numbers. It buys mechanisms. And the mechanism evidence increasingly points to a silver market that is becoming more sensitive to industry and supply chains, ranging from industrial narratives to a critical minerals framing. So the right question isn't, will silver hit $150? The question is, when does the market price silver as a strategic input, not just a safe haven? When the market changes how it prices strategic, price can gap. But that shift also invites regulation, standards changes, and responses from large industrial consumers. That's why silver cycles often run with two narratives in parallel. One side says deficit, the other side says bubble. A serious counterweight is the bubble argument, relative valuation signals and historical abnormality. You need that voice inside the same video. On the other side, the industrial case leans on solar, electronics, and the constraint that supply doesn't scale quickly because silver is largely a byproduct. When those two narratives collide, you get the sessions where silver rises like a rocket and falls like a stone. That silver signature. And that's also why a $150 call spreads so easily. In a high volatility environment, extremes can sound plausible, but we should close with a practical test. In 2026, 3 dashboards are enough to judge whether $150 is becoming real. Dashboard 1, Industrial Demand and Solar Demand, Updates and Industry Reports. Dashboard 2, COMEX Registered Eligible, the official CME stocks report. Dashboard 3, SHFE turnover and warehouse stocks, evidence of money hitting the choke point, plus visible inventory changes. If all three align, industrial demand stays high, registered stays thin, SHFE turnover stays extreme while inventories fall, then $150 stops being a joke. If you only have narrative without the 3 dashboards, then $150 is a headline. Maybe true for a moment, but wrong in substance. And if the market gets hit with cold water by rebalance flows and margin hikes, you can see the opposite. High volatility, but a broken trend, and the $150 prophecy pushed back. Bottom line, the bullion dealer, 150, is a useful pretext to examine the spine of the silver market, not to pray for price, but to understand structure. Silver, at $150 Oz in 2026, can only be durable if it comes with one underlying truth. Silver is critical in both the industrial sense and the policy sense, and the fact that the U.S. used the word critical minerals and placed silver into that framing is a detail that makes the 2026 story different from older cycles. But precisely because it's critical, the market becomes more intervention-prone. Standards, surveillance, and leverage controls, things that can break vertical moves. If you want a single NYT-style closer, $150 isn't a forecast. $150 is the market's stress test of deliverability. And that test will happen in 3 places. London Vault mobility, COMEX registered tightness, and Asia's choke point where delivery and leverage collide. In 2025, silver already had an abnormal year. In 2026, the question is whether that abnormality gets legitimized by structure or written off as a bubble. That SY the dealer, $150, has value as a media anchor. It forces hard data onto the table. The biggest bullish data point, solar and electronics demand, plus the lag in supply growth. The biggest bearish warning, mechanical selling, rebalance, leverage crackdowns, margin, and bubble risk in an asset that's moved too fast. If you remember one number from this video, it shouldn't to be 150. Remember 243.7 million ounces of silver for solar in 2024 because of that AES demand with a reason. And remember 127.26 million ounces registered on COMEX, 501, 2026, because that's metal that can be pressured for delivery. And finally, remember 1.051 trillion CNY of SHFE turnover in a single day, 12/31, 2025, because that's the footprint of flow large enough to break short-term control. Three numbers, 243.7, 127.26, 1.051 T, are enough to track whether $150 is arriving or just a headline. The dealer's $150 can be right or wrong. But if it's right, it will be right because the market admits one thing. Silver's price is the price of deliverable metal, not the price of a story. And if it's wrong, it will be wrong in the most silver way. An overextended run gets cut by leverage and mechanical flows, then the cycle restarts from a new equilibrium. Today's video doesn't sell $150. Today's video sells the mechanism of a metal that's both a safe haven and a strategic input. And that's why silver is stepping out of gold's shadow, quietly outperforming at times, powered by an industrial story. If 2026 is truly moving toward $150, you'll see it first in the data. Solar demand, thin registered inventory, and a choke point being hit repeatedly by flow, not in prophecy. Now we move into the quantitative check. Is $150 Oz a forecast or just a sales narrative? The first problem, who is the forced buyer? If it's industry, they buy because production requires it. If it's speculation, they buy because expectations and leverage demand it. There's a very concrete anchor. Industrial demand in 2024 was 689.1 million ounces, with solar alone at 243.7 million ounces. That's not emotion, it's physical demand from real production lines. So the real question is, at what price does that 243.7 million ounces get broken by substitution, silver thrifting, or delayed installations? This is where many bullish pitches glide past reality. High price does not automatically mean demand 1T fall. It only means demand may fall more slowly than supply can adjust in time. The second problem, can supply actually rise? Silver is often a byproduct of other metals, so supply response to price usually has a long lag. Meaning, even if prices scream, you can't flip a switch and create deliverable metal within a few months. That lag is where volatility is born. The third problem, deliverable inventory. COMEX doesn't lack total ounces in warehouses. The issue is registered, metal that is actually available for delivery. One snapshot puts total registered around 127.26 million ounces. If delivery demand concentrates into that narrow door, the paper market tightens. And don't ignore eligible, around 322.51 million ounces. But eligible only becomes a fire hose if the owners choose to convert it. And they only choose to convert when price is attractive enough. This is a cold, psychological financial mechanism. I have metal is not the same as I am willing to deliver metal. Inventory is physical, willingness to deliver is financial. The fourth problem, Asia's choke point. SHFE is a deliverable market. One widely cited figure shows roughly 1.051 trillion CNY of SHFE silver turnover in a single day. At that scale, the story is no longer retail buying a few bars. It's a crowd hammering on a system with a delivery door, and SHFE inventories have been cited around 669.547 tons. If inventory falls while turnover explodes, stress rises nonlinearly. That's why, in a $150 scenario, I don't T-watch TV prices. First, I watch withdrawal speed in warehouses and the intensity of delivery-focused flow. Now we shift to policy, the part that makes $150 feel less fantastical. Because policy can change the rules faster than supply and demand can adjust. When a commodity enters a critical framework, it gets treated like infrastructure, not just an investment. That changes how companies and states behave around stockpiling. Read the language closely and you see the strategic logic. Minerals stop being cheap inputs and become inputs that must be certain. And certainty always has a price. Once policy starts speaking in terms of urgency, Markets ask a practical question. If it's truly urgent, who holds inventory and for how long? Zoom out. Major economic blocs are pulling raw materials into an economic security frame. High-level political messaging isn't about silver specifically, but it establishes the environment. Dependence becomes vulnerability, and secure supply chains become a priority. When politics says, without critical raw materials, there is no green transition and no future technology, industry hears it in one sentence. Securing supply matters as much as optimizing cost. That's fertile ground for long-lived premia. Defense matters too, because it's the least price-elastic buyer class. When defense participates in supply chains, it adds a layer of demand that is driven by availability, not price. Now bring it back to $150. It only has a real lane when 3 layers stack at once: industry, finance, and policy to protect security. A simple stress model looks like this. Industry holds demand, financial markets amplify volatility, and policy raises the cost of holding strategic inventory. Under that combination, price can gap. But an investigation must be precise. Gapping up is not the same as staying up. Price can touch $150 in panic and slide back to $110, $120 if logistics reopen and mobilization improves. So we split $150 into 2 versions: a $150 spike, brief peak, and a $150 plateau, a new floor. Only the second one is true repricing. To get a plateau, you need one condition. Large pools of metal don't release fast enough. That's where London gets discussed. Not as a headline number, but as a question of true liquidity, mobility, and willingness to transfer ownership to crush spreads. Because when markets are stressed, holders tend to tighten their grip, not loosen it. And when capital costs rise, carry metal to arbitrage spreads becomes a game for the strongest balance sheets. That's why dealers use the word banks in titles. But even banks have a fear. If a physical spread persists, physical buyers start doubting the benchmark price, and the market loses confidence in its reference. This is where the script must stay cold. No conspiracy talk, just plumbing. When reference trust cracks, premium becomes the real price. Now return to the total demand scale. Roughly 164.1 million ounces in 2024. That's large enough that $150 cannot be explained by one small group alone. Industrial demand is the anchor of the story. So if someone says $150 because retail buys bars, the proper response is, retail can create spikes, but holding a floor requires industry plus deliverable inventory constraints. Now we face the risks that break the $150 path: technical risk and mechanical flows. Rule-based selling doesn't need a viewpoint. It needs a rule. That's why so many silver rallies end with a vertical drop. In a crowded market, mechanical selling can trigger dominoes. Then comes the margin break, forced liquidation. People who are right long-term get removed because they can't meet short-term cash requirements. In cycles that want to reach extremes, you often see 2 phases. Phase 1 flushes weak leverage through margin pressure. Phase 2 snaps back via delivery stress, often faster than expected. In other words, margin-driven drops sometimes clear the runway for the next squeeze because fragile leverage has already been purged. Now, the headline angle, Bullion dealer reveals. Treat it as a warning light. Dealers see premia, they see flow, they see retail level availability tightening. But an investigation must separate retail scarcity from system scarcity. Retail scarcity can occur even when total warehouse stocks look large. It can reflect bottlenecks in minting, shipping, distribution, and psychology. So the key question is, how does retail premium become a market-wide repricing? The answer is the delivery door. If pressure hits registered inventory, COMEX, or hits a deliverable mechanism in Asia, SHFE, it touches price discovery itself, not just store shelves. And trillion CNY turnover days are a clue that crowds can hit that delivery mechanism, at least for a period. In that environment, the dealer isn't necessarily inventing a story. They may simply be amplifying what they see first in distribution channels. To stay disciplined, we define a $150 indicator set in priority order. First indicator, solar and industrial demand does not weaken sharply. Second indicator, registered inventory declines rapidly or stays thin for an extended period while delivery demand rises. Third indicator, regional spreads persist, and arbitrage can't close them, accompanied by signals from SHFE warehouse data or vault mobility. Fourth indicator, the critical minerals framework pushes companies into strategic stockpiling, raising inventory demand even as price rises. If those 4 indicators all flip on at the same time, $150 stops being a shout. It becomes the natural outcome of a market repricing disruption risk. Now we destroy one common misunderstanding. $150 does not require the world running out of silver. It only requires the delivery node getting jammed. And jammed can happen when silver is in the wrong place, the wrong form, the wrong specification, or in hands unwilling to sell. London can hold huge tonnage, but if it doesn't flow, exists does not mean mobilizable. COMEX can show large combined stocks, but if registered is the narrow door, the deliverable spot can still be tight. SHFE can show meaningful inventory, but if turnover surges while inventory declines, the market can tip into buy first, ask later. That's how extreme prices are born, not because Earth is empty, but because allocation can't keep up with a demand shock. And when political language calls supply chains a vulnerability, companies have even more reason to hold inventory rather than release it. Once national security language appears, commodity pricing often enters a new phase. Price reflects not only supply and demand, but a geopolitical risk premium. That's why, even if you don't believe $150, you still need to understand how $150 can become reasonable in panic. And that's also why silver rallies are rarely pretty. They're often violent sequences of up and down days where the winners are those who survive volatility, not those who guess the best headline. The final step is evaluating the dealer's credibility. The question isn't, did he say $150? The question is, does he provide warehouse data, delivery data, and premium data? If it's only customers are buying, that's anecdotal. If it's linked to registered levels, vault mobility, and SHFE turnover, that's structural reasoning. And if it's connected to the critical minerals framework and defense investment in supply chains, that's policy reasoning, another layer that makes $150 more than a meme. If rebuilding domestic capacity takes time, then any supply chain premium that forms can persist. And markets often price it takes time by raising prices today. Now we frame it cleanly. $150 in 2026 is a tail risk scenario, not the most likely outcome, but the highest impact one. Tail risk wins in media because it shocks. In finance, tail risk matters only when you understand the trigger. The triggers here are high industrial demand, a thin delivery door, and a liquidity choke point that can be overwhelmed by flow, plus policy and security logic that increases the incentive to hold inventory. If you see those pieces converge in the same quarter of 2026, $150 can appear faster than you expect and disappear just as quickly. If they don't converge, $150 becomes a classic bull market peak call, compelling, viral, and then abandoned when data fails to confirm. And this is the last point to keep. In silver, the real question isn't who is right, it's what is scarce, silver itself or deliverable silver in the right place. Once you can answer that with data, you've already cleared 90% of clickbait. 3 anchors summarize everything in this segment. 243.7 MAs for solar, or 127.26 MAs registered on COMEX, and 1.0521 trillion CNY of SHFE turnover per day. If solar stays strong, registered stays thin, and turnover surges while inventories fall, you have the base for a $150 spike. If you add critical policy and strategic stockpiling behavior, you can get a shot at a $150 plateau, even if not for the entire year. But if mechanical flows and margin pressure tighten, you'll see violent drops that break positioning, and $150 gets pushed back into not yet. That's why this is an investigation into mechanism, not prophecy. A bullion dealer may see something before you do, but the data will confirm or reject it. And if 2026 truly moves toward an extreme, the first signal won't be on a chart. It will be in warehouses, delivery stress, policy language, and the way companies start buying because they fear shortage. Silver at $150 can be a moment, or it can be a floor. But only if you track the right choke points will you know whether you were living in the real story or just inside a headline.